I was really happy with my 15-year mortgage term until I wasn't. If only there was something I could do.
I know. It's time to refinance. Welcome to the Red Desk. Refinancing is a word you hear a lot, even if you aren't hip to the real estate lingo. It basically means swapping your current mortgage for a new one. So if you owe $150,000 on a loan, your new lender will come in and pay off the old mortgage. Refinancing means new rates and new mortgage terms. Don't worry, you'll get the paperwork. There are all kinds of reasons people refinance. Some big ones are getting cash from your equity, lowering your payments, and even shortening the term of your loan. Interest rates are always in flux. If you bought at 6% and rates are at 5%, that can be a huge difference in interest over the lifetime of a loan. Refinancing gives you the chance to take advantage of that. Or maybe you got an adjustable rate mortgage, an ARM, to save on interest, but you'd like to refinance to a fixed rate mortgage while rates are low. Or maybe you finally have enough home equity to refinance your FHA loan to a conventional so you can stop paying your mortgage insurance premium. Both are good reasons to refinance. Switching from a 15-year to a 30-year loan can drop your monthly payment, but you'll spend more in interest. The reverse is also true. Refinancing can help you make choices around loan length and how that affects payments and interest. With the cash out refinance, you borrow more than you owe on your home and pocket the difference as cash. So if your home's value is up, you may have enough equity to take cash out for home improvement, debt consolidation, or anything else. Refinancing can make that happen. There's a type of refinance for just about any situation. Rate and term is the most classic refinance option, which just takes your same mortgage amount and changes the interest rate and terms of the loan. Cash out refinances let you take a bigger mortgage and pocket your equity. If you already have an FHA, VA, or USDA loan, you may qualify for what's called a streamlined refinance, which is typically an easier process and requires less documentation since you're staying with the same type of loan. There are also refinances that pay you based on the value of your home, and refinances that don't have closing costs, refinances that... You get the point. You have options, and you should research which ones make the most sense for your unique situation. The only way to figure out if refinancing does or doesn't make sense is by crunching the numbers. If you're locked in at a low rate, refinancing may not make a lot of sense. When determining the right move, you also need to calculate how much a refinance will cost to close. It's usually 2% to 6% of the loan amount, which can add up. On a $150,000 mortgage, that's $3,000 to $9,000. You can also use our calculator to get an idea of what refinancing can do for you. Check that out at rocketmortgage.com/calculators. You might think it's difficult or will take a lot of time, but once you talk to your lenders and run some numbers, you'll realize you can cross the finish line in 30 to 45 days. You're a pro, and here's how to make it happen. Step 1, do your research. Compare different types of loan options that are available to help you accomplish your financial goals and run the numbers. I'm gonna say it again for the people in the back. Do your research, because this matters. Step number 2 is compare lenders. It'll be like comparing apples to apples, but just like when you first got your loan, your lender will need to verify your income, assets, credit, and more. So be sure to have the appropriate documents ready. Step number 3, lock or float your rate. After you're approved and get a rate quote, you usually have to choose if you want to lock in your rate or gamble with the market leading up to your close date. If rates are trending up, you should probably lock. If they're trending down, you may be able to negotiate a float down option. Regardless, if you are pumped up about a rate, you may want to lock it in to be safe. Step number 4 is underwriting. Just like when you got your first mortgage, your lender is going to want to poke around your financial closet for a bit. Just hand over the flashlight and be as accurate and transparent as possible. Number 5 is the appraisal process. Your lender will need to make sure your home's value is accurate, so they'll order an appraisal. If your home's value is equal or higher to the loan amount, you're golden. If it comes back low, you may have to cancel or accept a lower loan. And finally, step number 6, the close. Once underwriting and the home appraisal are complete, it's time to close your loan. This means signing the closing disclosure that highlights all the final details and paying any remaining closing costs if you aren't rolling them into your new loan. I know that was a lot, but honestly, I held back. I could talk refinance for hours. If you want, you can just keep playing this video over and over and over and over and over and over again for the full effect. But seriously, these decisions have a big impact on your financial life, and you should treat them with care. And if you're feeling overwhelmed, we've got home loan experts who are here to help you get started. Want to explore some financing estimates? Check out our Rocket Mortgage Refinance Calculator. Thanks for checking us out. If you'd like to see more videos just like this, you know what to do. Click right here, and as always, like and subscribe. We'll see you next time.